Hey guys, and welcome to the Trading Channel. My name is Steven, and I am the owner of the TradingChannel.net, an educational website providing traders with strategies and coaching for their trading journey. If this is your first time viewing one of my YouTube videos, then make sure you click that subscribe button because I do come out with free educational content from time to time here on YouTube. And by clicking subscribe, you will be alerted by email once I do come out with those videos. And if you are a returning subscriber, then I just want to say thank you for the support and thank you for sticking it out throughout this past month or so since I have not been able to produce much content for YouTube. And the reason is because I just launched my first subscription service for the website. This subscription service is called the EAP, or Email Analysis Program. In this service, I provide traders with 3 to 5 emailed analysis per week showing them the trades that I'm taking and why I'm entering such trades. For a limited time, I'm also offering these traders free access to my condensed training course. This course is going to show you, with absolutely no fluff, exactly how I trade the markets every day. This is 2 45-minute videos showing you the exact rules and the exact conditions that I need in order to trade in the markets. And this is the same system that I, as a professional trader, use in the markets every day. So if you're interested in signing up for the EAP, then make sure to head over to the TradingChannel.net. There will be a link in the description below. And if you sign up before this Friday, you will also receive the free condensed training course, and you will receive the discounted price of $29.99 instead of the full price of the service, which is $39.99. So if that's something you're interested in, then head over there. But for now, we'll go ahead and get back to what we're going to talk about today in this video, which is how to use moving averages to trade in the Forex market. And moving averages can be used for a variety of different things in the Forex market and in any market, a few of which are to determine trend. You can use them in confluence with other indicators to create a strategy, such as confluence with the RSI. And obviously you can use them as a strategy development technique. You can use them to create rules around for your strategy or as an entry reason, such as a moving average crossover strategy. That's what we'll be discussing today, so if that sounds interesting, guys, then sit back and relax, click that like button while the intro and disclaimer roll, and I'll be right back to talk to you a little more about moving averages. Alright guys, so we'll go ahead and get started with moving averages here in just a second. But I have been getting questions asking me which strategy did I actually use in my real account while trading Forex professionally, because I do have quite a bit of strategies that I teach for free here on my YouTube channel. And the answer is, the real strategy that I use is the one that you'll learn in the EAP. The things I teach here on the YouTube channel are all strategies that I've used throughout my trading career at some point, and they've all proven to be profitable for me with the way that I've tested and the way I trade them. The reason I do this is because there's different personalities for different traders. Some traders will migrate towards different strategies and will be more comfortable with a strategy like a moving average strategy that's completely non-subjective, while another trader may be more comfortable trading based on structure, which is a bit more difficult, but different people understand different things in a variety of ways. So we'll go back to what is really important. The most important thing in your trading is that you have tested a plan, whether it be something I teach here on YouTube, or if you sign up for the EAP, you test that plan as well. It's not a service where you don't ever have to test anything. As soon as you learn it, you need to be testing it in the market, as with any other strategy that you learn from anyone, or any strategy that you create on your own. So the first rule is get your plan together, get your strategy together. You can find tons of strategies for free here on my channel or other places on the internet. All it takes is to take that strategy that you learn and test it through historical data. Go through 100 trades. Look at what happened the last 100 times that those rules, those specific rules for that strategy were met, and see if it's profitable and see if you're comfortable with the risk that comes from that strategy. These moving average strategies that I have used and tested in the past are some of my favorites because of how non-subjective and rules-based they are. You're basically trading off of lines on the chart, the lines being the moving averages. So it's a situation where if you asked 100 traders if the blue line is above the white line in this area here, then 100 traders would tell you, yes, the blue line is above the white line, which is why I really, really enjoy the moving average trading strategies, and using a moving average to determine trend is also completely non-subjective as well. So let's dive a little bit deeper into these moving averages. We'll look at determining trend first. So what would be a way to determine trend using a moving average? Well, here, and guys, I'm actually using black charts, which I know is not normal. Normally I use white charts. So if this is something that you like, make sure to leave me a comment below and let me know that you like the darker charts. And if it's not, then leave me a comment below and I won't do this again. But as you can see, my white line is a 200 EMA. This is one of my favorite moving averages for determining trend. The 200 exponential moving average is used widely by a lot of retail traders and used by big banks and market movers. So if everyone else is using it to determine trend, then I see it as a good idea for me to use it to determine trend as well. Sometimes it's a good idea to follow the herd, especially in a situation where you're trading trend continuation. So that's one way to determine trend in a market. And what I like to do is if I want to find a stronger trend, all I do is drop the number. For instance, go from a 200 to a 100, and then you can test a trend continuation strategy only when price is under a 100. And if you're considering a breakout trade, we like breakouts whenever the market is very volatile, whenever the market is moving down at a very fast pace or moving up at a very fast pace. In this case, the market would be moving down. So if you're trading a breakout strategy, it may be a good idea to go all the way down to a 20 period moving average and trade breakouts based on this 20 period moving average. So at this point you would say we're on a 1 hour chart on the pound Aussie. I'm going to trade the break of a structure low if price action is below the 20 period moving average. So here is the break of a structure low. You could have your orders placed a few pips below that as a sell stop order, like so, or you could sell based on the close of this candle with stops above the previous swing high, which would be here. So there's a few ways that you can use the moving averages in order to determine trend. And you don't have to stick with just the 20, the 100, and the 200. I also really enjoy using the 50 period moving average. Now those are about the only 4 moving averages that I ever pay attention to. And I never have them all on the chart at one time. I do like a very clean chart because I mostly trade structure. But another way you could determine trend is by putting 2 different moving averages on a chart and creating rules based around this. An example would be if the 20 period is below the 100, then the market is in a downtrend. And you can go a step further with this by adding a 50 period moving average, which will keep you out of some consolidating markets. And let me show you what I mean by that. So if you were to add 3 moving averages to your chart to determine trend, your rules could be when the 20 is below the 50 and the 50 is below the 100, we are in a downtrend. There could be your first rule for a strategy. Your second rule could be when another situation could be when the 20 period is in between the white 50 and the blue 100, then we are in consolidation, and you don't look for trend continuation trades while in consolidation. Again, these are just examples of some rules you could create around moving averages. And here you see that the 50 and the 20 are above the 100, and there's a non-subjective rule for being in an uptrend. So now you have a non-subjective rule for downtrending markets and a non-subjective rule for consolidation when the 20 is in between the 50 and the 100, and a non-subjective rule for an uptrend. Based around that, you can create an entire trend continuation strategy. So what you can say is, and these are just examples, these may not be strategies that I've actually tested, but you can say, if my moving averages tell me we're in a downtrend, we have the 100 with the 50 below and the 20 below that telling me we're in a downtrend, then I sell the 20 period moving average every time the market touches it. Now, as I said, this is probably not a profitable strategy. It's nothing I've ever tested, but that is just an example of a rules-based strategy. And if you tested that and it came up with a positive expectancy, that would be your back testing results, and you could decide from there whether or not you were comfortable with the risk involved in that strategy and whether or not to trade that with real money. That is how simple trading can be. You can create your rules-based strategy based around 3 different lines on a chart or any other combination of these lines and structure, and later we'll talk about a combination of these lines and other indicators in order to create non-subjective rules-based strategies that are easy to follow, and if they produce a positive expectancy, then they could possibly be a successful trading strategy for you. So back to the charts. Here we're talking about a non-subjective way to determine a downtrend, which is all three of our moving averages, with the 50 below the 100 and the 20 below the 50. Here we would have had a win if we were trading directly off of the 20 period moving average. Another example would be if the market trades above the 20 and then comes back below the 20, sell the close below the 20. You can use a number of different reasons for entry, and that unfortunately is what most traders miss in their strategies. A lot of people create strategies. There's no shortage of strategies, I promise you that. But the reason for entry is the most important part of the strategy. In order to create a successful trading strategy, you need a certain set of conditions followed by a set of rules for entry. So, for example, our condition would be the moving averages lining up in this way, showing us our non-subjective downtrend. Now that we have condition 1 met, which is the moving averages, now we need to create a rule for entry. Our rule for entry could be a number of different things, and that's for you to decide and test for. I'm just giving you examples of ways you can use moving averages in order to create strategies. So here's another example of something that would be testable. When I have all three moving averages lined up in a downtrend and the market pulls back but does not reach the 50 period moving average. And guys, you could write this down as notes and really test these strategies to see if they're profitable. But anyway, when this is the case and we have our moving averages lining up, plus we have price action that has not touched the 50 period moving average, now I look for breakout trades. Ascending triangle with a breakout to the downside. And the other condition would be if the market touches the 50 before breaking below my trend line of my breakout trade, then I do not trade the breakout. So there's a way that you can determine trend, determine volatility by not letting the market touch the 50 EMA, and capture a trade based around a good entry reason, which would be a breakout trade, using triangles, pennants, and other things that have been discussed on this channel. If you're interested in learning how I trade triangles and pennants, I'll post a link to the Trading Simple Patterns video that I created, and if you click that, it'll open in a separate window, and you can watch that after this video. So here we have a very volatile downtrend, the market pushing down, and the pullbacks don't even reach our 20 period EMA, as you see. So now we've reached our 20 period EMA, and I see another good trade based on the rules we had back here. So this may be a strategy worth testing, guys. I'm literally creating a strategy as I speak with you here now. So this should give you a really good idea of how I create strategies, which is a very important part of trading Forex or trading any market. So as you can see, all the rules from this previous trade are actually met again as we trade down, still in our downtrend according to our rules based on the moving averages, with the 50 below the 100 and the 20 below the 50, looking for a breakout trade before the market touches the 50 period moving average. And look what we get. Here is a nice wedge pattern following a impulsive move down, followed by a breakout to the downside. That would have been another win based on this strategy. So now that we've talked a little bit about how to use these for determining trend, and I know I got off topic a little here talking about how to use them to create strategies, but now what I'm going to do is take a few of them off and show you a couple of other strategies that you could create using a moving average. So we've been determining trend this way. Let's take off a couple of these and leave ourselves with just the 100 EMA. Now the 100 EMA, I've noticed throughout backtesting, is one of the best to trade off of. So if you'll notice here, the market has been in a heavy downtrend. Once we actually retrace all the way up to the 100 EMA, that 100 EMA sometimes does push the market back down pretty dramatically. And again, we break above the 100, come down to the 100, and market is pushed up by that 100 EMA. This is especially true when the 100 EMA lines up well. Let me make that a different color, sorry guys. Lines up well with previous structure. So here we have a 100 EMA, 1, 2, 3, 4, 5 different points of structure that have been tested at the same level, and the market is rejected off of that level and that 100 EMA. So there's another good trading strategy that's testable, verifiable, and repeatable, which are rules that I like to use for any of my strategy creation. And if we continue to look back and see how that strategy would have performed in the market previously, you can see that on this specific pair, the market does come down to that 100 EMA and get pushed off quite a bit. And that's something else that's very important when creating a strategy, guys. There are going to be certain pairs that react differently to different things, especially when you're dealing with moving averages. Some pairs react very well to a 50 period, or a 20 period, or a 100 or 200 period moving average. And some pairs do not. So that's why it is very important to test this yourself. As you can see here, would have been a losing trade. We came up, tested the 100, pushed down a little, but not enough to hit any kind of targets. And as you can see, while the market is trading under the 100 or 200, if I add that back, period moving averages, then that is a pretty clear determining factor for trend. As you can see, while we trade under that moving average, we continue to go down. And then when we get above the moving average, we put in a period of consolidation, followed by a new trend up, followed by more consolidation, and then finally a breakout to the downside to continue our downtrend. So there, guys, is a good way to determine trend and try to create some strategies based around moving averages. Now what we'll look at is adding other indicators to your moving average while determining trend in order to create an entry reason based on an indicator, which, as I've said in other videos, I'm not a huge fan of using indicators to trade, but they do make a strategy very non-subjective and rules-based, which I am a huge fan of, because the more simple and easy to follow a system is, the more likely you are to have success with that system. So let's take a look at a different pair now. And I'm just going to pick a random pair, Aussie Canada, why not, and let's delete all the drawings that are on here now, and get rid of the 200. So now we're on the Aussie Canada with a 100 period moving average. Now what are some other commonly used indicators? Obviously an EMA is a pretty commonly used indicator, and if we take a look down here, you'll see that I have an RSI, which is a 7 period RSI, and the inputs that I use on my RSI are a 7 period RSI with a 75 overbought line and a 25 oversold line. Now with this being the case, you could combine the two indicators in order to create a strategy, and let me show you a very simple way that you could do that. So you could take our RSI down here in combination with our 100 EMA. We already know from the previous pair we were looking at that the 100 EMA is sometimes respected as support or resistance in trend. So as you can see, the market is trading above the 100 EMA. We pull back down to the 100 EMA. And when do we want to buy off of the RSI? Well, based on the relative strength index, we would like to buy when the market is oversold. So let's combine the two as a rule for a strategy and see how it would have performed. As you can see here, market in an uptrend pulls back to the 100, which we know sometimes acts as support. If we look down on the RSI, I'll put a vertical line in here to help you see this. Here we are as we pull back, and if we go straight down, you can see on the RSI here, we are oversold on the RSI when we pull back into the 100 EMA. There are two really good conditions that you could use in order to create a strategy. Now remember what we said before. Conditions are not all you need to create a strategy. Now we have conditions. What do we need next? Rules for entry. So a non-subjective rule for entry for this specific strategy could be when the market breaks back above the 25 line on your oversold. So when the market goes from oversold and comes back out of oversold on the close of the candle that's out of oversold, you could enter the market. There's your reason for entry, and that's the huge thing that most traders miss. A lot of traders want to trade support and resistance. A lot of traders want to trade off moving averages, but they don't have a clear set of rules for entry. And most of the time, they don't even have a clear set of conditions that must be met before they can even look for a reason for entry. And these are two things that as a professional trader you really need to have in your trading plan. Otherwise, you will probably lose money. So that would be a good example of a rules-based trading strategy. And let's continue to look through the market here and see if we could have won a few more trades based on that strategy. Here you can see that the market came very close to being oversold, and that part of the strategy would obviously be up to you, as with all other parts of this strategy. But you could make a rule that says your RSI can be within 2 or 3 points of oversold, or you could even move the oversold line up a bit and test it, make sure you test it, to see if that would make the strategy more profitable. So let's continue down through the chart. As you can see, we actually go oversold right at the 100 EMA. Right in here is the market is oversold at the 100 EMA, so the buy would have been on the candle that closed out of that, which would have been this really big green candle, which in my opinion is too big to buy, so I would have waited on a pullback and had my stops under this previous swing low. Not sure if they would have been clipped or not, and I'm not going to go through and check that, but we'll continue to look and see if there were any other opportunities according to those rules. As you can see here again, very, very close to being overbought at this area, but not quite there. And we are up against our 100. The next place we get overbought, we're way too far above the 100 to call that a test of the 100 EMA, so that would not have been a trading opportunity. But based on the rules we created, this would have been a trading opportunity right here. And the reason it's a trading opportunity is because the market was previously trading below our 100 EMA, pulled back to our 100 EMA. While pulling back to the 100 EMA, the market went overbought. After the market was overbought, it came out of overbought, and there's our entry reason. So condition 1, market trades under 100 EMA. Condition 2, pull back to 100 EMA. Condition 3, market goes overbought. Entry reason, market comes out of overbought. Guys, this is a strategy that is testable, verifiable, repeatable, and has everything you need for it to be a successful forex, a successful trading strategy if you commit to testing it. And if you commit to trading it based on your backtesting results using a very good risk management plan. It is literally that easy, guys. It's not a very complicated process to become a professional forex trader. It's not easy. It's just not complicated. It's as simple as the rules I've just shared with you. Creating a strategy based on a set of rules, testing that strategy to see if it's profitable. If it's profitable, trading it in a demo account to see if you're comfortable with the profits you make versus the risk and the losses that you incur while trading that strategy, and then deciding whether or not it's worth trading with real money. And guys, those are just a few examples of successfully trading off of this 100 EMA using the rules that I've said. Here's another great example. Oversold market at the 100 EMA after trading above it, and as you can see, huge profits could have been made on this specific trade. As I said, guys, definitely worth testing, but do not trade it without testing it, because at that point you're just trading in the dark. You have no idea what your risk management plan needs to be, and I promise you, you will not be able to withstand the drawdown that every system comes with. Not just this system. I'm not saying this system has a terrible drawdown. Every system has a drawdown. No matter what you trade or how you trade, you will lose trades. And sometimes those losers will come in a large number. Sometimes you'll lose 7, 10. There's been points when I've lost over 10 trades in a row. But I use a risk management plan that allows me to withstand that kind of drawdown. Alright guys, so that's how you can use other indicators in confluence with EMAs of any kind. Does not have to be the 100. You could use this with the 200. You could use it with a MACD indicator instead of the RSI. This is just an example of a way you can use moving averages in confluence with indicators in order to create a strategy. And now throughout the video we've already been talking about strategy development using these, so I'm not going to talk much more about that, and this video is getting a bit long, so it is nearing the end now. As you can see though, we are involved in a position up here in this area, and I'll zoom out to the 4-hour chart and take off the indicator, because for this position I actually did not use any indicators whatsoever. This is my structured trading that I use for the EAP, the email analysis program that I was discussing in the beginning of this video. And as you can see in the program, this was a trade that was alerted to the subscribers a couple of weeks ago. Our entry was on this long wick candle that you see. The entry of this trade was actually based completely on the rules that I teach in the emailed analysis program and the rules that you'll learn if you decide to sign up before Friday in the free condensed course training. So guys, if you really want to know exactly how I trade, then make sure to head over to thetradingchannel.net and subscribe to my emailed analysis program. I try my best to produce very, very good content here on YouTube that you can actually use in your trading. And if you guys think this is good content, then I cannot wait till you get over to the Trading Channel and check out the EAP subscription. That program is at a super low cost. It's only $29.99 a month right now, and that will be the price until this Friday. And guys, that's less than what most people pay for coffee each month. Google did a survey, and the survey concluded that the average American worker spends $20 a week on coffee. Now that equates to $80 a month. So you can get into a program that could possibly change your future as a trader for half of what most people spend on coffee. Don't be scared to invest in yourself, guys. $29.99 is less than what most people spend on blue jeans. And it's not really for me to say, but I can imagine that you could probably skip that next pair of blue jeans if it meant you learning a successful Forex trading strategy and being mentored by a professional trader. And I'm not trying to make this sound like an advertisement, guys. I'm just extremely excited about that program, and the response I've had to it so far has been incredible. So if you're interested in learning more about that, there will be a link to my website in the description below this video. Make sure to check that out. If you're new to the YouTube channel, make sure to subscribe. Please hit that like button before you go if you enjoyed this video. Leave me a comment below and let me know what you thought about it. Also, let me know if you like these darker charts. Have a great rest of the week trading in the markets, and I'll talk to you guys soon.